Good morning, everyone. Thank you for joining. Okay, today we are talking about something every one of us facing right now. How should we have to invest when markets are uncertain? Because market today are not moving in a straight line. There are constant news around global tensions and volatility around us. So, and naturally it creates confusion. So, question like, should I invest now? Should I wait? So, what is the right approach? So, in this session, we are not going to predict the market. Instead, we will focus on something more important: how to think and act in uncertain times, because uncertainty is not new, but how you respond, it makes all the difference. So by the end of the session, we have a clear and practical approach to invest with most confidence. So let's start. So over the last few months, if you have been following the markets, one word that clearly stand out is uncertainty. So markets are moving up, but at the same time there is fear. Some news looks positive while some create concerns, and as investors it becomes difficult to understand what exactly is happening. So today let's understand why everything feels uncertain now. First, we are seeing conflicting signals everywhere. On one side, the Indian economy is doing relatively well, growth is stable, and some companies are reporting decent earnings. But on the other side, the global things are not good. There is a volatility in the global market, so interest rates are very uncertain. Global growth is slowing in some areas. So because of this, we are getting mixed signals. Like, should we be positive? But on the other sense, the global sense are not strong. There is a volatility in the global market. Interest rates are uncertain. So growth is very weak in certain areas. So because of this, we are getting the mixed signals. Should we be positive or should we be cautious? And this confusion creates a lot of hesitations in our investment decision. So second thing is global risks keep shifting. So every few weeks, a new risk coming. It could be geopolitical tensions or some trade related issues or changing global economic policies. For example, in recent times, US-Iran tensions and rising instability in the Middle East have increased uncertainty across global markets. So why does this matter? Because the Middle East is a key supply for crude oil to the world. Whenever tension rises in the region, oil prices tend to spike due to the fear of supply disruptions. So for a country like India, which imports a large portion of its oil, this creates multiple pressures like higher inflation, pressure on our rupee, and increase the cost of companies. So this directly affects profitability and overall market sentiment. So even if our domestic economic is stable, global risks like this keep changing in the direction of the market as well. So third, market valuation looks stretched. Over the last couple of years, especially in some of the mid and small cap segments have delivered very strong returns. So because of this, valuations have moved above the historical average. So now this doesn't mean markets will fall immediately, but it doesn't mean that expectations are already high. So when expectations are high, even a small negative trigger can lead to a correction. So this makes investors more cautious and uncertain. So and finally, there is a constant news noise. So every single day we are exposed to multiple headlines, market falling, like rupees weakening, oil price rising. So the global tension also increasing. So when investors keep consuming this information regularly, it creates anxiety. So instead of focusing on long-term investing decision, we start getting influenced by the short-term news. This is where the most mistakes start to happen. So when we combine all these factors like conflicting signals, changing global risk, high valuations, and continuous news flow, it is completely natural to feel uncertain as an investor. But here is something very important to understand. Uncertainty in market is not something new. It is always existed in different forms at different times. The real difference between the successful investor and average one is not their ability to predict market. It is their ability to stay disciplined and make the right decision during the uncertain times. So, and that is exactly what we will focus on the next part of the session. So now that we understand why market feel uncertain, the next important question is what exactly is driving this volatility? Because markets don't move randomly; they are always designed between these ups and downs. So let's break this down in a very simple way. First, geopolitical events. This has become one of the biggest reasons for volatility today. For example, the ongoing tensions involving the US and Iran and the broader instability in the Middle East area. So now you might wonder, how does it affect us? It's very simple. Middle East is a major supplier of the crude oil. So whenever tension increases there, the biggest fear is what if oil supply gets disrupted? Even if nothing actually happens, just the fear itself is enough to push the oil price higher. When oil prices move, market react immediately. So today, markets are not just reacting to numbers; they are reacting to global events happening far away from us. And the second one is rupee depreciation. Let's bring this closer to India. When the rupee weakens against the dollar, it creates a chain reaction. India imports a lot of things, especially crude oil. So when the rupee weakens, we end up paying more for the same imports. Now, what happened because of this? Our fuel cost goes up. When fuel cost goes up, almost everything becomes expensive. Transportation cost increases, logistics become costly, and even daily goods can become expensive. This leads to higher inflation. At the same time, FIs also become very cautious because when they invest in India, currency movement also affect the return. So, if the rupee keeps weakening, some of these may reduce their investments, and when the large investor sells, markets become volatile. And the third, as everyone know, the crude price spikes. So India import around 80 to 80% of its oil. So when oil price rise, it affects the entire economy. So if fuel becomes expensive, companies have to spend more. Transportation cost goes up, production becomes expensive, and when cost goes up, companies profits can get affected. So oil price don't just impact petrol prices, they impact the entire business environment. So that's why market reacts strongly to oil movements. Fourth, the fear of corporate profitability slowdown. Now this is what markets are really worried about. When companies start facing higher costs, whether from fuel, raw materials, or currency, their profits can come under pressure. Even if sales are growing, profits may not grow at the same pace. And market always look at the future. So even the expectation that profit might slow down, it creates nervousness. So that's why sometimes you see markets falling even when current result looks okay, because markets are already thinking again. And finally, the interest rate uncertainty globally, especially in the US, there is still no clear signal on when interest rates will come down. So inflation is still a concern. So rates are staying higher for longer. So now, because of this, when interest rates remain high, investors become a bit more cautious globally. Money doesn't move as freely into the market like before, and that can lead to more ups and downs. Now, from an Indian perspective, this is also a matter because India is connected to global markets. When global rates stay high, the rupee weaken, company may face higher cost, and overall market sentiment becomes slightly cautious. So even if our economy is doing relatively well, these global factors still influence our markets. So now when you combine all these factors like geopolitical tension, rupee depreciation, rising oil price, and the interest rate uncertainty, you get a market that is very sensitive. Even a small news can move market very sharply. And here is the most important thing I want you to understand. Volatility is not random. It is a reaction to all these underlying factors. And once you understand this, your thinking start changing. Instead of reacting emotionally to every market move, we have to start looking at the bigger picture. And this is where most of us goes wrong. We started to react to every movement without understanding the reason behind it. So in the next section, let's talk about the biggest mistakes we make during the uncertain times. So in uncertain market, the biggest problem is not the market, it's how we begin. Because most losses don't happen only because market fall. They happen because of the decision we take during those times. And if we are honest, almost every investor has made at least one of this mistake. So let's look at the first one, trying to time the market. How many times have you thought like, we will invest when the market's correct a little more, and then what happens? The markets don't fall, it starts going up again, and now we feel like we missed the opportunity. Then we will again wait again, and finally invest when markets are already high. So sometimes the opposite happens. We invest when market falls, and we think we should have waited. So these things keep happening. So the truth is, no one can consistently time the market. Even professionals get it wrong. So instead of creating returns, timing usually create regret. So Second thing is reacting to news, not strategy. So think about your daily routine. We open our phone, see a headline, market fall due to these kind of global tensions, and we immediately start thinking we have to sell something, or when market goes up, should I invest more? This is how most of us operate. So, but the reality is, by the time news comes to us, markets have already reacted. So when we act on news, we are already read. That's why reacting to the news leads to the poor decision making. And the third thing is exiting after market fall. This is one of the most important emotional mistake. Imagine, say, if we invested 1 lakh in equity or something, market falls and it becomes 85,000. Now, what happened mentally? We don't think long term anymore. We just wanted to avoid further losses, so we exit. So what did we actually do? We converted a temporary loss into a permanent one, and then after a few months, market recover. Now we are stuck outside thinking, should we have to reiterate again? So, and most people re-enter at the highest level. This is how wealth most of the time get destroyed, not by the markets but by our behavior. Fourth one is over concentration in recent winner. This is something very common. Let's say a segment or themes are giving great returns. So everyone around us talking about it. Social media is full of talking, and WhatsApp message, everything is about the segment or theme. So what we actually do, we start shifting more money into the segment because it feels like this is where the growth will come. But by the time it becomes popular, valuations are already high, and when correction comes, the same segment fall the most. So what felt like a smart move actually increases our risk. And finally, ignoring the asset allocation. This is the most silent mistake, because many of us put almost everything into equity because equity gives higher return, but they ignore one important thing: balance. So, yeah, 100% equity portfolio may give higher returns, but it also come up with sharp ups and downs. So now imagine a portfolio with a mix of equity, debt, and some other asset classes. Return may look slightly moderate, but the journey is much smoother. And a smooth journey means you are more likely to stay invested. But because at the end of the day, returns matter, but behaviors matter more. So if you look at all this mistake, timing the market, reacting to news, exceeding in panic, chasing winners, and ignoring election, there is a one common factor: emotion. Fear when market falls, greed when market rise, and these emotion drive most investment decisions. So because successful investors do something different, they don't try to control the market; they control their behavior, because it's in the long run. It's not about how the market performs; it's about how we behave during those phases. So now let's understand one of the most important concept in investing. Honestly, if you understand this clearly, your entire approach to the market will change. This is the difference between uncertainty and risk, because most of us confuse these two, and the confusion leads to the wrong decision. First, we start with uncertainty. Uncertainty simply means not knowing what will happen next, and that's exactly what we are seeing in market today. Market feels unpredictable, news is constantly changing, and in the short term, direction is not very clear. For example, one day market go up sharply, next day they fall because of some random news. So naturally, it feels uncomfortable. But here is the key point. So uncertainty is normal. Markets have always been uncertain. Even during a strong bull markets, those were periods where nobody knew that what would happen next. So now let's look at risk. Risk is very different. Risk means permanent loss of capital, not temporary ups and downs, but actual loss of your invested money. For example, if you invest in a poor quality company and its business start falling, that's the risk. If you buy a stock at extremely high valuation and the growth doesn't match expectation, that's a risk. If your entire portfolio is concentrated in one sector and that sector underperforms, again that will be a risk. So risk comes from what you invest in and how you structure your portfolio, not from the daily market movements. Now, here is where most of us go wrong. They treat uncertainty as risk. When market becomes volatile, they feel like something is wrong. They think market is risk. I should exit now. But in reality, when they are seeing is uncertainty, not a risk. Like during COVID, also market fell sharply. There was extreme uncertainty. Nobody knew how bad things would get. Many of us exited during that phase, but what happened is, so those who exceeded didn't avoid the risk, they actually created loss for themselves because they acted on uncertainty. But now think about the opposite case. If someone invests in a big company just because it is cheap or trending, and that company never recovers, that is the real risk, because the money may not come back. So the problem is not uncertainty, the problem is how we respond to it. So smart investor, and they try to understand the difference. So they accept that uncertainty is temporary, but they focus on that. But the main focus is on managing the risk properly. So they invest in quality asset. They avoid overpaying. They diversify their portfolio. So even if market fluctuate in the short term, long term outcome is protected. So and this is the mindset shift we all need to have. So we don't get rewarded for avoiding uncertainty, because if you keep waiting for clarity, we cannot invest. So we get rewarded for managing risk, but by staying invested, by making disciplined decision making, and by building a strong portfolio. So let's make this very real and practical. So instead of theory, let's look at four different type of investors. All of them start at the same point, same amount, same market, same opportunity. But the difference is how they behave, and that completely changes their outcome. So let's start with the first one, the holding steady. The person invests 1 crore before the COVID crash in January 2020. Then what happens? Market crashes sharply, fear is everywhere, news is negative. But this investor does nothing. No panic, no reaction, just stay invested. Watches the fall and then watches the recovery. And over time, still end up generating around 10% annual return. So it's not extraordinary, but it's a stable one. Now the second investor buying the dip. This is someone who stay calm under pressure, same starting point at 1 crore. But when market crash in March, April, May, and during the 2020, when fear is at its highest, the investor actually had more money. This is not easy, but when markets are falling, everyone around you is negative. But this kind of investor stay disciplined and uses this as an opportunity. And what happens? This strategy delivers the highest return, around 12% plus. So it's really simple. Volatility, if we handle correctly, can actually improve our returns. Now let's look at the third investor, confidence buyer. So this is very common. We wait, we don't invest during the crash. They wait for things to look better, market recover, news eyes are made. Suddenly some confidence come back. So then they invest. This feels safe, but the problem is they miss the recovery pace. So even though they invested in a rising market, their returns are lower than someone who invested during uncertainty. So fourth one is panic selling. So this is where most people unfortunately fall. The same starting point, when market fall, fear increases, and we started to exit. Think we will protect our capital, but when market recovers, it's still very confused. So they re-enter at very highest level. So what they have done, sold at low and bought at high. And because of this behavior, the returns dropped significantly, almost to 7%. So same market, same starting point, but completely different outcomes. So now you look at these four investors carefully. The difference is not intelligence; it is just a behavior. The best performing investor is not the smartest one; it is the one who stayed calm and acted with discipline. And the worst performing one is not unlucky, and it is the one who reacted emotionally. Now ask yourself honestly, which investor do you want to relate with? So have you ever waited for the perfect time, or exiting during a fall, or invested only when things felt comfortable? Because most of us have done this at some point. So this is very completely normal, because our goal is to improve here, because market will always have uncertainty. There will always be another crisis, another correction. So another headline will be on trending. But our success as an investor will not depend on those events. It will depend on how we behave during those times. So now here this slide is extremely important because it gives us the historical perspective. Whenever there is a fear in the market, it feel like this time it is different. But if we study history carefully, we realize something interesting. Markets have faced uncertainty many times before: wars, geopolitical tension, terrorist attack, trade conflicts, global crisis. And yet over time, markets have shown resilience. Let's look at some example here. After the 9/11 attack in 2001, market reacted sharply in the short term. Uh, there was panic globally and uncertainty was extremely high. But if you look at the long-term picture, market eventually recovered strongly. Similarly, during the Iraq War in 2003, market corrected initially, but over the next few years, the returns were significantly positive. Even during the 26/11 Mumbai attacks, despite the emotional and economic shock, markets stabilize and recover over time. So then we had the Russia-Ukraine war in 2022. At that time also market corrected because oil price surged, inflation increased and global risk was very high. So and what are we seeing now? Very similar concerns again today because of the US-Iran tensions and broader Middle East instability. Markets are once again worried about again the rising crude oil prices, inflation pressures, and global slowdown fears and the currency weakness. So, in fact, if you see the current situation, we are already around 2.5 months into this phases of elevated geopolitical tensions and uncertainty. And naturally, investors are asking, will markets continue falling? Should I wait? Is it safe to invest now? But this is where historical data becomes very useful. If you look carefully at the table, one thing becomes clear. In most cases, market reacted negatively in the short term. It's completely normal because fear always creates short-term volatility. But over a longer period of time, markets have generally recovered and delivered positive returns. In fact, as mentioned below, Nifty delivered positive returns in 8 out of 10 cases after 1 year because it tells us something very powerful. Market may react emotionally in the short term, but over time they adjust, stabilize, and move forward. So why does this happen? Because business adapt, economics recover, and uncertainty eventually reduce. So now this doesn't mean every event is identical. So every conflict has different economic consequences. For example, if oil price rise sharply for a prolonged period, the impact can become more serious. So we should not blindly assume markets will always bounce back immediately, but history clearly shows one pattern. Extreme fear phases have usually turned out to be temporary, and investors who stayed disciplined during those periods were generally rewarded over the long term. This is why emotional decision making becomes dangerous because during uncertainty, investors focus too much on short term fear and ignore long term probabilities. So if someone exited markets during every major crisis like Russia, Ukraine, or COVID, they would have missed some of the strongest recoveries in the market history. So the lesson for us is that market may fall, but it's just a part of the journey. So those who have stayed invested will get rewarded for this. So now let's bring everything together into something very simple. What should we actually do as an investor in a market like this? Because after all this discussion, this is the most important question. Let's break down into a very few practical steps. First, invest consistently. Don't wait for the perfect time. Many of us keep thinking, I will invest when market correct more, or I will wait for more clarity. But the reality is that perfect moment never comes. Market moves quickly. So instead of trying to time everything, focus on consistency, whether through SIPs or paced lump sum investing. So keep investing regularly because over time, consistency reduces the risk and improve your outcome. And the second one is stay focused on your goals. This is something very important, but often we ignore. Markets will keep moving up and down, but your goals don't change, whether it is buying a house, retirement, or long-term wealth creation. So instead of tracking the market daily, focus on whether your investments are aligned with your goals. Because when you focus on goals, short-term volatility matters less. And the third one is avoid expecting quick returns from equity. This is a big mistake everyone do because in invest in equity and expect result in a 6 months or 1 year, but equity doesn't work in a way. In the short term, markets can be unpredictable, but over the long term, they reward the patience. So if you enter equity, enter with the right mindset, give it time because expecting quick returns often lead to disappointing and wrong decisions. Fourth, stay disciplined and avoid emotional decision. This is probably the most important point because market will always test your patience. There will be cases where markets fall sharply, every news becomes negative, and fear is getting increased. And during those times, your first reaction may be due to something like to exit or to change your strategy. But that's most of us do because reacting to every moment leading to very inconsistent results. So instead, we try to stay disciplined, follow our plan because long-term success in investing is not about being right all the time. It's about avoiding the wrong decision. Now, if you look at all these points, they are simple. There is nothing complicated here, but the challenge is not understanding them. So, because during uncertain times, our emotion is taking over. That's where structure and discipline become more important. So you don't need to predict the market. You don't need to find the perfect opportunity. We just need to stay consistent, stay focused, and stay disciplined. Because in the long run, that's what create wealth. Once you follow this approach, uncertain markets stop feeling scary and start becoming. You can easily manage those uncertainty. So let's go one level deeper. Let's talk specifically about equity because equity is where most investors feel both excitement and fear. So the question is, how should you approach equity in uncertain market like today? So let's break it down. First, focus on quality over momentum. In strong bull markets, almost everything goes up. Even an average or weak company start delivering returns. And during that time, many of us get attracted to momentum. So they invest in what is going up fast. But when this kind of uncertainty increases, the market becomes more selective. That's when quality matters. Companies with strong balance sheet, consistent earning, and solid business model tend to hold better. So during correction, a fundamentally strong company may fall 10 to 15%, but a overhyped company can fall 30 to 40%. So the downside risk is very different. That's why in uncertain times, it's better to focus on quality rather than chasing fast moving stocks. So second, avoid chasing overrated segments. This is very important in the current market. Whether a particular segment performs well, we start shifting more money into it because it feels like this is where returns are coming. But by the time everyone start investing, valuations are already high. So when valuations are high, the margin of safety becomes very low. So even a small negative trigger can lead to sharp correction. So we have seen this happen multiple times in the past. So instead of chasing what has already run up, it's better to cautious and selective. And third one is deploy capital gradually across market level. Now, this directly connects to the problem of timing. Many of us keep asking, is this the right time to invest? But the truth is, you will never get a clear answer. Markets don't give perfect entry points. So instead of trying to invest everything at once, a better approach to spread your investment. So invest a portion now. If some correction happen, you can invest later and more if market fall. This way, you are not dependent on one single entry point, and more importantly, you reduce regret. So because when market go up or down, you are already participating. And the fourth one is stay diversified across segment. This is again something many of us ignore. We put most of the money into one theme or one segment. Let's say for in mid or small cap, or putting in one sector like banking, IT, or defense. Because a market moves in cycle and different times, different sector perform. So if your portfolio is concentrated, your performance becomes very dependent on one segment. But if you are diversified, you reduce the dependency on the one segment or theme. So some part of your portfolio may underperform, but others will compensate. So and overall, your journey becomes smoother. So equity investing is not just about finding the best stock. It's about managing the risk and behavior. In uncertain markets, returns don't come from the aggressive decisions. It's come from the most disciplined decisions. So choose. So instead of choosing momentum, choosing quality, and avoiding the overvalued areas, investing gradually, staying diversified. These may sound simple, but these are exactly the things most of us ignore, and that's where the difference comes. So you don't need to be aggressive in uncertain markets. You need to be smart and disciplined because in the long run, wealth is not created by taking extreme bets. It is creating by making consistent and well-balanced decisions. So let's talk about the other side of the portfolio debt. Most of us don't give it enough importance to it because it doesn't look exciting. It doesn't give very high returns. But in uncertain market, debts play a very important role. It provides stability. It protects your portfolio when equity becomes volatile, and more importantly, it helps you stay invested without panic. Even in debt investing, there are mistakes investors make. So let's understand how to approach debt correctly in the current environment. First, prioritize safety over high returns. It's very important. So many of us look at debt funds and think this fund is giving higher returns. Let me invest here. But in debt, higher return usually means higher risk, and that risk is not always visible immediately. Let's say if you take two debt funds, one is giving 6% and another one giving 8 or 9%. So naturally, we start attracted to the 9%. But the question is why it is highest? Because most of the time, because the fund is taking extra risk, either by investing in low-rated companies or taking a high duration calls. And in uncertain markets, this extra risk can backfire. We have seen in the past where some debt fund face issues and investors were stuck or saw losses. So in debt, it is idea is to not maximize return. It is to protect capital and generate stable income. So the second one is avoid the credit risk. This is one of the biggest risk in debt. So credit risk means the possibility that the company you have lent money to may not repay. Now, in good times, this risk doesn't look visible. Everything looks fine. But when the cycle turns, we start seeing problems. Companies face cash flow issues, repayment gets delayed, and in some cases, default happen. When these things happen, your investments also gets impacted. So that's why in uncertain markets, it's better to stick to high quality instruments where the probability of default is very low. The third is avoid duration risk. Now, this is something many of us don't fully understand. Duration risk is basically sensitivity to the interest rate changes. When interest rate goes up, long duration bonds tend to fall more. When interest rate fall, they benefit more. Now, the current situation is the uncertainty around interest rates are very high. So we don't have clear visibility on or when rates will fall or go up. So if you take long duration exposure now, we are taking a directional bet, and if that bet goes wrong, your returns can get impacted. So that's why in the current environment, it's safer to stay in the very short duration space. So because when where interest rate impact is limited and then your returns also more stable. So that is not meant to be exciting, but it is meant to be bring balance to a portfolio. So instead of asking which debt fund gives you highest returns, better question is which option protects my capital and gives stable returns. Because in uncertain markets, stability is very valuable. It helps you stay calm, it gives you liquidity, and it gives you the confidence to continue your equity investments without fear. So let me take a few minutes to explain how we approach investing here, because everything we discussed so far, uncertainty, volatility, behavior, asset allocation, all of this need to be come together in a structured way, and that's exactly what we focus on. First is milestone-based planning. We don't look at investing as just putting money into markets. We connect investment to real life goals. For example, buying a house, children's education, retirement, because when investments are linked to milestone, decisions become much clearer. You are not reacting to market movements anymore. You are focused on achieving a specific outcome, and that changes your entire mindset as an investor. Second, safety and discipline over chasing return. Most of us get attracted to high returns, but what we have seen over time is chasing returns often lead to inconsistent outcomes. So instead, we focus on protecting capital, maintaining discipline, and generating sustainable returns. Because in the long run, consistency more than the short-term outperformance. And the third one is behavioral coaching and conviction building. This is something we do as investing is not about products or market, it's about behavior. Even a good portfolio can fall if the investor is not able to stay invested during tough time. So a big part of what we do in investor is stay calm during volatile times and avoid panic decisions and building conviction in our strategy. So as we discussed earlier, the biggest risk is not the market, it's how we respond to it. And the fourth one is review and adjust through milestones. So investing is not a one-time activity. As life changes, as market changes, your portfolio also need to evolve. So we don't just invest and forget. We review portfolios periodically. We check, are we on track toward goals? Has the risk profile changed? Does the allocation need adjustment? And based on that, we make necessary changes. So this keeps the portfolio aligned over time. And finally, customized mutual fund portfolio using a multi-asset approach. There is no one size fits all solution in investing. Every portfolio is designed based on individual goals, individual risk profile, and market conditions. And certainly, we follow a multi-asset approach, which means combining a equity for growth and debt for some stability. Because as we discussed here, this is what makes a portfolio resilient. Now, if you look at the entire approach, it's not about finding the next best fund. It's not about predicting the market. It's about creating a system that's help you stay disciplined, manage risk, and achieving our financial goals over time. Because at the end of the day, successful investing is not about doing extraordinary things. It's about doing the right thing consistently over time. So that's exactly what we aim to help with. So, and just give you overview of who we are. M2W stands for Milestones to Wealth, and we are a mutual fund distribution platform focusing on helping investors building wealth in a structured and disciplined way. And M2W, our mission is very simple. We aim to help investors think bigger and move towards achieving their first floor with clarity and confidence. Because in our experience, most investors don't lack opportunity, they lack structure, discipline, and the right guidance. So that's exactly what we try to solve. So over the last 10 years, we have been working with investors across different stages, from beginners starting their journey to experienced investors looking to structure the portfolio better. Today, we manage over 1,200 crores of asset and work with more than 7,500 clients. But more than numbers, what really matter to us is the approach, because our focus is to help investors to avoiding mistakes, stay disciplined, and build long-term wealth. So we believe wealth creation is not about shortcuts. It's a journey, and with the right structure, it's become much more predictable and less stressful. So now, before we close, let's simplify everything into a clear action plan, because after all this discussion, the most important question is what should we actually do from here? So first, review your current portfolio. Take a step back and look at what you currently have. Ask yourself, is my portfolio aligned with my goal? Am I overexposed to one segment or asset classes? Does my portfolio match my risk tolerance? Because many times portfolios are built over time without a clear structure, and in uncertain markets lack of clarity creates more stress. So the first step is awareness. The second one is avoid extreme decision. In volatile market, the biggest mistake is taking extreme decision, either exit completely out of fear or investing aggressively out of excitement. Both can hurt your long-term returns. So instead of reacting, focus on staying balanced. Small thoughtful adjustment work much better than big emotional decision. Third one is start or continue discipline investing. So market will always move up and down. So there will never be a perfect time to invest. So the consistency is so the key here is consistency, whether through SIPs or paced investing. Staying investor regularly helps you reduce the timing risk and build wealth over time, because long-term investing rewards discipline, not a perfection. So, and finally, use volatility as an opportunity. This is a mindset shift. Instead of fearing a market correction, start looking at them as an opportunity, because when market fall, valuation become more reasonable, future return potential improves. So if your portfolio is structured well, you can actually use volatility to your advantage. So now, if you look at all these steps, there is nothing more complex here. The challenge is not understanding it. So because during uncertain times, our emotions took over. So that's where structure and discipline become more important. So the final key, key takeaway I want to leave with this: you don't need to predict the market. You don't need to get every decision right. You just need a clear plan and the discipline to stick with it. Because in the long run, that's what creates successful outcomes. So thanks for joining.